Central bank of any country uses three tools to control money supply. These are open market operations, the required reserve ratio, and finally the discount rate. Open market operations are used by central bank to purchase and sell treasury securities to influence the money supply. And open market purchase indicates the buying of government securities by the central bank. When the central bank buys the securities, someone who holds the securities has to sell it. So, an open market purchase by the central bank increases money supply. And open market sale indicates the selling of government securities by the central bank. In this case, the central bank sells government securities to the public. So, an open market sale by the central bank decreases money supply. Let's look at how open market operations affect the money supply when central bank purchase government securities. It increases reserves of the financial institutions, and in turn it increases money supply in the economy. Similarly, when government sells government securities, it decreases reserves of the financial institutions, and in turn it decreases money supply in the economy. Now we look at the required reserve ratio. Banks around the world are legally required to reserve a portion of the deposit that they collect from the depositors. And central bank of any country can change the required reserve ratio. So central bank can influence the money supply by changing the required reserve ratio. So reserve requirement, it means the rule that specifies the amount of reserve a bank must hold to back up depositors. In this case, an increase in required reserve ratio by the central bank will lead to a decrease in the money supply. Similarly, if central bank decreases the required reserve ratio, it will increase the money supply in the economy. Finally, we'll look at discount rate. Discount rate means the interest rate charged by the central bank to provide loan to the financial institutions or to the commercial banks. So, discount rate is the interest rate of the central bank. And increase in this discount rate relative to the call money rate leads to a decrease in the money supply. Similarly, a decrease in the discount rate will lead to an increase in the money supply. Let's look at how tools of the central bank can change money supply. First of all, open market operation. If central bank is involved in open market purchase, it will increase money supply. And if the central bank is involved in open market sale, it will decrease money supply. Then, required reserve ratio. When central bank decreases required reserve ratio, it will increase money supply. And when central bank increases required reserve ratio, it decreases money supply. Finally, discount rate. Lower discount rate helps to increase money supply. On the other hand, higher discount rate helps to decrease money supply.